Hey guys, welcome to this video. Just a quick run over on the audio. And don't forget to get my free training underneath. It will help you out an absolute ton and dispel any of those bad trading strategies that you're using or any bad thoughts you have. Right, let's get into it. So on our AUDJPY, and I did a video about this before, I spoke mostly about the most important thing that you can see with your AUDJPY at the moment. It is this consistent sideways movement over an extreme period of time. Where I've just labelled with these green arrows demonstrates to you really key price action and preferred buying zones for long-term investors. You saw that as price bottomed out over such a long period of time. I mean, we can go back as far as you want. It's just come down. But if you just glance at the screen now, you just save this in your memory, you can see that the market for your AUDJPY over the very long term has just gone sideways. Okay, and you can therefore clearly label areas where people are getting long. Okay, some people call this demand, some people call it all sorts of things. In a way, I would say it is demand, but you don't necessarily need to sit and think about how people have got orders there. Just understand that that is clearly a preferred price for long entries because, believe it or not, it's right in front of you. The price has rallied away from there 4 times in the past. Okay, so that can't just be coincidence, can it? I mean, some people think it's magic, but it's just not. It's just factual trading, okay? It's just where people say, you know what, that looks good for long entries, and no surprise, really, if you're bottoming out at 60 over here, off from the back of, being at 260, 270 yens per dollar, it's a considerable discount over the very long term. That's why people like it long, but more so you can see that it has got to the point where it's bottomed and rebounded in the same area. Now, in the same sense, and this was in my last video, I said about how if you look to the top side, you've got the same thing more or less. You're coming to the same area and price is pulling away. So at this point, people are preferring this for shorts, and where I've labeled it, albeit taking a very long time to get there. The last took from 2020 to 2023 and 8 years from 2015 to 2023. Okay, but it would have paid off if you then did take it long. But it's really simple, guys. The best way to trade this over the long term is to understand from 1991 to 2023, 32 years, you would have made money if you shorted up here and bought down here. Okay, as long as you had an appropriate level of stop or no stop indeed, like myself, you would have made the right decision. And what you also would have done is you would have been trading with the long-term market and trading with institutional and professional traders alike, because they too see these levels and say, I'm a market trader, I'm a business, essentially trading is a business, you're a businessman or woman if you're trading, and they say, you know what, it's going to be beneficial for my business if I short at high price, okay, I sell high, and I buy low at low prices. And I can use the gauge of the market to understand that. I can use price history to understand what is a low and high price, because low and high prices are formed where people massively buy and they massively sell after a sustained period of movement. Now, you haven't hit back on your earliest key moving average since June 23, okay, which is a very long time, and you haven't hit on your 40 MA for even longer, okay, nearer 2020. So this amalgamation of MAs is often very ideal lower down. I think you may run into some very early support and very early problems. I've just taken it lightly long at this point. And if it does turn out that you bounce, beat this high and come slightly higher up, it wouldn't shock me at all. But anything really in this region for me is just re-short entries. It comes well in line with key price action levels over the very long term. You can see that. And that is ideal for shorts, especially if you're a swing trader. If you're going to look long and you're more risk averse, you probably want something like this. You probably want a much further dip back to some key levels of support. Okay, and that would take you more or less in line with that area of support. You often find, and especially like I said, if it's taken 8 years last time, or 8 years and then 3 years last time, you're going to have bumps in the road. The reason why it takes so long is because price doesn't like to just fly exactly up to the other end of the sideways movement. Okay, it stops in between because it hits levels of support and resistance that jams the log, if you like, and that's why you don't always go straight up. You tend to take a staircase movement, essentially. So I wouldn't expect anything really to change in this 30-year trajectory, really, unless you get an enormous change in monetary policy on either side. That is more beneficial for the AUD against the yen, or more beneficial for the yen against the AUD. In either case, you would just have to wait for further comments from central bank bodies. But that's what's kept this sustained in the same area. Okay, it's the fact you don't have a considerable change in that monetary policy to deliver this. Okay, and it's a lot different for other pairs. If you look at New Zealand dollar, dollar yen, stuff like that. Price action is slightly different, but again, you're not seeing a massive change yet in monetary policy on either sides, which would cause a significant deviation. Although I do expect you to pull back a fair way soon because you've come up for 3 years. It's an awfully long time. Okay, so any pullbacks, I like it long lower, and anything higher, I think you'd be ideal to short nearer 100. Hope that helps, guys. As always, don't forget to get my free training underneath. Thanks for watching, and of course, as always, I will see you in the next video. See you there.